So good morning to you all. My name is Gil Arazi, and I'm super excited to be here today. I was born and raised in Tel Aviv. I live in Tel Aviv. I spent 21 years in the insurance industry, and 6 years ago, I established FinTLV. FinTLV is a leading global Insurtech VC. We have $500 million in asset under management. As you can see, we have invested in some of the top leading Insurtech companies in the world. I think our unique approach to VC is coming from our investors that are only in insurance companies. We invest only in Insurtech companies. And I think the most important part is the ecosystem, which we'll discuss about it later. So we deeply believe in the power of this ecosystem. We try to provide value to this ecosystem by having relationship with hundreds of insurance groups, insurance carriers, reinsurance companies. And we believe that there is much more power in this ecosystem than the sum of its parts. And this is, I think, why today we host on this stage leaders from different angles of this ecosystem. And we'll discuss about the hot topics in the insurance industry from the perspective of an Insurtech company, insurance company, and of course, investors. So let's introduce our guests, Bolttech, Corvus, Hippo, and Next Insurance. I was so fortunate to have you today, guys, the leaders of these leading Insurtech companies. So thank you very much, Rob, Madhu, Guy, and Rick for joining us today. And maybe we'll start with a short introduction. Maybe Rob will start.
Super. Hi, everyone. Really great to be here. My name's Rob Shimmick. I'm the CEO of Bolttech. We are a high-growth international insurtech, and we're on a mission to create the world's leading technology-enabled ecosystem. And what we do is connect our insurers with distribution partners and with the customers. And in short, you could sort of think of it as we're just trying to make it easier to buy and to sell insurance. Now, at the center of what we do is the world's leading technology-enabled insurance exchange. And just to give you an idea of what that is we connect the sell side or the supply side of insurance with the demand side of insurance. And we do that in the last 12 months by providing about $50 billion of quotes across the Bolttech platform.
That's amazing.
So it's pretty, you can identify with that scale. Now, we also do something else at scale that's interesting, which is we operate in 30 countries around the world on 3 continents. And what we do is we bring insurance expertise and we bring licenses in all of those 30 countries, in all 50 states here in the United States, and the technology that's necessary so that any partner we deal with can have everything they need to have so that they can distribute insurance.
Amazing, amazing. Rick.
Well, first of all, before I get started, the introduction when we were walking on stage depressed the hell out of me. And I need to schedule a session with the executive coach that just left because I was really pumped to be here today, and now I'm not so sure. But in all seriousness, I'm Rick McCatherine. I'm the CEO of Hippo Insurance. I've been with Hippo from the beginning. Hippo exists to protect the joy of home ownership. And we think insurance is an important part of that journey. But the other aspects of that journey is sort of our view that the best claims experience is the claim you never have. So what can we do with proactive, preventative, IoT, risk mitigation to help the customer protect that joy of home ownership? And that's why we exist.
Guy.
Hi, good morning. I'm Guy, one of the co-founders and the CEO of Next. Next Insurance is a company that's doing insurance for small businesses. Our vision is to provide to small businesses insurance that is simple, 100% digital, one-stop shop, everything that they need, affordable, priced with a lot of technology and data, and tailored. There are thousands of different professions. Every profession has different needs, and we want to give kind of the right tailored solution to each one of the profession. Next is a 6-year-old company. We have today multi-lines in all 50 states in the United States. We are selling $800 million in written premium, and we have over 400,000 customers right now.
Amazing. Madhu.
Yes, hi, everyone. I'm the CEO of Corvus. We are an insurance focused, MGA focused on cyber insurance. That risk is so different from most of the other risks that insurers think about. The assets, the digital assets that are being protected, the digital business operations that are so crucial to companies just require a brand new way of underwriting and policyholder management. And so our business, which is 5 years old from the ground up, is built with the data, technology, and interaction model to really help address and work with customers on that risk.
Amazing. So let's start working, guys. I think if I'll do a poll now, the first question to be asked is about valuations, of course, right? So I think during the dot-com bubble, Amazon fell by 94%. But after 20 years, the results are breathtaking with 431x on a dollar. And I think my first question is to you, Rob. Are there Insurtech companies that will emerge as winners in the future after the crash that we saw in valuations?
So let me say very simply, 100% yes. You're looking at some of them on the stage, by the way. But I say this.
I could not agree more, of course.
Thank you. Look, yeah, I think it's sort of simple. Creating the future of any industry, creating the future of the insurance industry, it's hard. And you're going to have the ability to withstand a lot of uncertainty, a lot of challenges. And anyone who thinks this is unique to an Insurtech, you're fooling yourself, right? Anyone who knows me, I spent 12 years of hard labor at a 100-year-old insurance company. And rest assured, they have challenges too. So whether you're an Insurtech or whether you're an established player, it is really, really, really tough. But this is an industry as a whole that what we do is so important to society. So we are working really hard to make sure that we can help people find more ways to protect the things that they need to protect in their life. And I think that that's what each of my colleagues in their own way are doing also here. So, when I think about who will be the winners, it's sort of simple. You've got to have a really good business model, and then you have to have balance. Because if you don't have sort of the financial discipline to make sure that you run a company that can achieve sustainable high growth, but at the same time, with a clear path to profitability and manage your cash appropriately, then you're going to really struggle. But the companies that are able to do those things and do them well, they're absolutely positively going to succeed. And so for Boltec, we've only been around since 2020, but I think we meet each of those descriptors that I just gave to you. We've got a great business model, and we're really focused on the things that it takes to make sure that we've got a sustainable financial future. But I think people, when they talk about the demise of Insurtechs, that's way overstated. You have to think about, do every other player in this industry, regardless of who they are, do they face challenges?
Yeah.
Yes, of course they do.
Yes, of course. So I'm taking this one step further and asking Rick, following your quote, what do you think, Rick, the investment community still doesn't understand about Insurtech?
Yeah, I think it's a really good question, and it's something that we struggle with. And frankly, we have not done a great job of helping the investment community understand it. And that's one of the things we committed in our Investor Day, is to do a better job of educating the street how different we all are.
Yeah.
I'm not even talking about good, bad, right, wrong. Every Insurtech company is different. Comparing Hippo to Corvus or Next or Bolt is just a bad comparison because they're different companies. We have almost nothing in common with Root or Lemonade, surprisingly, and everybody thinks that we're all the same companies. We're not. And so it's the uniqueness of what we're all doing to modernize the insurance industry that I think we need to do a better job of explaining to the street. The other thing that I think is really important related to that, and I was chatting with a group of folks on Tuesday, and we all as Insurtechs really do need to stick together, because as long as we're all painted by the same broad brush, One fails, we all fail in the minds of the investors. I look across the stage with my colleagues. We partner with Corvus, we partner with Next, we partner with Bolt on different aspects of our business. Some distribution, some fronting carrier, some sell us, some we sell, some are the platforms or our partners to sell us. So it really is important for Insurtechs to recognize that we all want each other to succeed. The market is massive, and as long as we explain what differentiates us to the investment community, I think we have that potential.
Great. So part of this, and I'm going back to you, Madhu, part of this is that we saw in the last year that a lot of companies has challenges in their business models, as Rob said. So after the market fell, what have you learned about business models and unit economics like LTV to CAC, et cetera, at Corvus?
Yeah, no, look, it's a great question. And I just can't shake this feeling of deja vu from when I was a early, fresh-faced venture capital investor in Silicon Valley in 99, 2000. And in 1999, if you added .com to your company name and you got valued based on eyeballs, and if you didn't have a product, you got valued on how many engineers you had, and millions of dollars per engineer was actually a metric. And sure enough, that was sort of 99, 2000 led to sort of that kind of chart. And then there was an abrupt crash. And the same investors who were saying, 6 months ago, eyeballs, were saying, .coms are terrible, nothing's going to come out of this.
Yeah.
And it took a couple of years for Salesforce, PayPal, companies to say, we've got real business models, we're actually profitable, we've got the right unit costs, and then the story turned around again. So I think we're in that valley right now where the metrics that were sort of everybody's focus area before, which is premium growth, TAM. I mean, show me a part of insurance where the TAM is not billions, right? That's like the silliest thing to focus things on, because every market is huge, but they actually don't get disrupted very often. And so I think we're in this shift now where it's going to switch to profitability, gross margin, loss ratios, good old things like combined ratio, that will actually sort of be the hallmarks of the companies that emerge from this. But right now, it was sort of all boom, all bust, and now I think the sort of sustainable business models will come and start getting, it's harder for CEO. Everybody would love to be in the tailwind where, the dumb and smart get compensated equally, but I think this is where really the sort of talent and durable business models emerge.
Yeah, I agree. So this leads me to the next question, which is following, and this is, I think if we were in 2020, the most important factor in explaining valuation multiples was, of course, revenue growth. And today, profitability is king, right? And profitability has surged to be the most significant correlate and predictor of companies' value. So, Guy, looking at growth versus profitability, what were the lessons learned for Next Insurance in the last year?
So I would say growth is extremely important, and definitely in the early days, you want to grow fast because you want to create scale, because scale matters, and it helps you definitely as an insurance company. When you need a lot of data, you need to grow fast. But even growth need to be profitable. So I don't think anything changed 5 years ago to now. When you grow, you need to grow with a positive unit economic, meaning every customer you bring needs to be profitable. And this was always true. It even changed, I think, this year versus 5 years ago. And we, at least at Next, always kept to make sure that when every customer we bring, at least we make money on these customers. Because bringing customers that you lose money on them doesn't bring any value to the business, almost any value to the business. What have changed in the last year is it's not just making sure that every customer is profitable, the actual company needs to be profitable. And that's the change that happened in the last year, which means that today raising money or money is more expensive or more scarce, and the entire company need to be profitable and be able to run and return to investor based on the revenue that they generate. And this is, I would say, the change that happened in the last year, and more companies are now growing a bit slower because they're spending less for the future, but taking the company to become profitable. And in insurance, it's below 100% combined ratios.
Yeah, I just want to challenge this because I still think that there are some companies that do not have a working business model, which means they would probably never become profitable. So, and this is something that the market, I think, understands now, and maybe this is part of the pendulum that we see in the market in terms of valuations and yeah. So let's move to the next question. Cyber and cyber insurance. So cyber is expected to grow like 25% per year. I think it's a huge deal in the industry. We're going to see huge transactions in cyber. But on the other hand, in cyber insurance, we have a lot of challenges regards with capacity, data, and of course, the most biggest one is the unknown certainty and exposure to cat events. So, Madhu, I'd like to ask you, what makes cyber insurance so unique and special? What is the real opportunity in cyber insurance, and how do you cope with all these huge challenges that you are facing?
That's a good question. I'm going to need that executive coach also.
Yeah.
But look, I think the great thing about cyber is it is a rare risk and insurance product where the customer demand is huge. Customers, new buyers are coming in, customers want to buy more and more, and there's been this sort of recognition that digital assets and digital operations are massively important to companies, and we're probably underinsured with traditional risk management products. So that's a little bit why we're in a lucky spot, even in translating growth and profitability, where that core sort of demand is there, and you're not just sort of trading or underbidding to get new customers. But the delivery of that is really what I think has led to the supply constraint, which is it's very different types of data you need to underwrite a cyber policy. You know, thousands of attributes of what a company looks like on the web, what their IT posture is, what their data recovery behaviors are, all things that were not traditionally part of the underwriting approach. And then crucially, once you've signed a customer, you need to stay in very close contact with them throughout the policy term. So seeing how they change, seeing what vulnerabilities and exploits emerge on the dark web, and going back to your policyholders. So a very different form of insurance, which I think kind of creates opportunity for companies like ours, where there's that great demand and where the incumbents are, I think, hesitant. And so that same, maybe this is to Rob's point, we sometimes think there's issues just for the insurtechs. There's even bigger worries with the incumbents about how to tackle this risk and think about it when they don't have the data and modern technology to sort of provide that. So the data, again, is the key. So being able to talk about aggregations, being able to respond quickly to customer outages or customer issues or attacks, that is a very different type of insurance and a different type of interaction model that I think actually is the right answer for customers, but then creates an opportunity for a company like ours that's new and brings those new approaches to bear. And it's an education approach. You know, we were sort of talking backstage. A year ago, everybody was worried about, well, what if Google Cloud goes down for 3 weeks? Is that modeled in? And there was a friend of mine who's at the Pentagon, we were talking to about this, and he said, look, if Google Cloud is down for 3 weeks, you probably haven't eaten for 2 weeks. So there's a real resilience in some of these systems, and again, it went from this is a reasonable risk, was written for 15 years without a lot of data, and then switched over to this sort of very panic mode. And I think we're helping really capital sources, customers, brokers see that there's actually a middle path, and you can manage and write this very profitably.
Yeah, it's a market under construction.
That's right. That's right.
And also the regulators will interfere with excessive loss layers, etc. So I'm sure.
Yeah, exactly. Everyone's learning, but if you've got the data and a modern kind of curious and agile way of responding to it, you're well positioned when there's disruption.
So let's move to our next topic. Thank you, Madhu.
Yeah.
Our next topic is embedded insurance. I think maybe the most discussed topic in the industry might be most frequently discussed, right? But the observation of what is embedded insurance for Boltec is quite different from what we see in the market. So I'd like to ask you, Rob, how would you envision the embedded insurance chapter being written, and vice versa? Later on, I would like to ask Rick and Guy, how do you see this embedded insurance platforms that you are using?
So I agree with you, first of all, Gil, that if you come to an Insurtech event and you don't hear the word embedded. The words embedded insurance, then you're not listening, because it's the most hot topic out there. I think that I think of it at times as a mental picture. It reminds me a bit of a young kid's soccer game, where all the ball goes to the left and everyone runs to the left, and then the ball goes to the right and everyone runs to the right. And I think sometimes when people think about embedded insurance, they're still playing that kid's soccer game. But we think that the embedded insurance story is much deeper than this. And you sort of hinted at it a moment ago with your comments, Gil, that we think about it as sort of having chapters. Chapter 1 to embedded insurance is where the soccer ball is today and everyone has chased it. And that's this concept of a very simple product at a very affordable price that's provided with a very seamless customer journey. And examples of this would be clicking to buy travel insurance when you buy your trip, or buying your cell phone insurance when you buy your cell phone. These are examples of places where Boltec plays. We do this very well. We love the space. But we believe that this is the beginning of the journey and far from the end. And if everyone thinks only about this single product, single provider, single simple user journey as being the full definition of embedded insurance, I think you're really missing a big part of what the future of embedded insurance will really be. Now, this embedded insurance that I just described, it's really going to be important to closing this huge $1.3 trillion gap in coverage that Swiss Re talks about. So I agree that it's very important. But we think of this at Bolt as being the beginning of the journey, because we think if you move past these simple impulse purchases, like you're buying a packet of chewing gum at the time that you're checking out at the checkout counter, but if you move to a higher ticket item like protecting your $750,000 home, paying $4,000 in premium to protect that home in the state of Florida, or insuring your automobile or your health. These kinds of things, the customer doesn't want the product to be with a single provider with no choice. They don't want an exact single product. And they might also want to have an online-offline journey where at some point in time, they might actually want to speak with a human being who can help them navigate through this. So we think of that as more like chapter 2 of the embedded insurance story. And chapter 2 is a big part of where the Bolt platform, the Bolt team plays. We love simple embedded chapter 1, but we're even bigger, having quoted last year $50 billion of premium in what we call the choice model. The choice model that's built to enable the customer to have the ability to choose carriers and to choose different kinds of features for the insurance that they want. And anyone who thinks that the book ends there, I think isn't being visionary enough, because that's only chapter 2 of a embedded insurance story. Chapter 3 is even cooler. A chapter 3 story that focuses on innovation and the whole idea of bringing services and capabilities that go well beyond choice. So for example, can we bring IoT leak detection sensors into a home to not just give you choice as to who your homeowner's insurance is, but also to help to avoid the loss in the first place, do some of the kinds of things that Rick and the Hippo team, for example, do. And do this in a very, very, very forward-looking way, but using that data, using that technology to actually have first responders come in and tell you, we can see that we think you have a problem, before that problem becomes a loss on the books of the insurance company, and before that problem becomes a loss to the insured whose home is impacted, as an example. And so I think that this is a multi-chapter story, and way too many people are focused just around chasing chapter 1. Chapter 1's important. Chapter 2 is really cool. Chapter 3 is going to be the real game, and it's going to be a lot of fun. So to watch this evolve over the course of the next few years, keep coming to this event, I think next year we'll be talking much more about chapter 2 and chapter 3.
So maybe I think Guy has a huge embedded platform, and Rick, maybe you would like to add something.
Yeah, so we not sure yet about the what chapter are we yet, still in the kindergarten. But embedded is extremely important for Next. 1/3 of our business is coming from embedded insurance. We believe that embedded insurance is more about digital ability to do it. And we saw when we are embedding and working with other companies, when we give 100% digital solution for the customer, that is a seamless experience where the customer doesn't leave the platform that they are staying on, be it on Gusto or Square or Intuit, and stay there on their platform and get a fully digital experience that is seamless, and they feel it's part of the system that they are using. We saw when we moved to complete digital a 2x conversion, which is massive in this thing. And it's a win-win for all the companies. Like it's win for the customers because it's easy for them and it's from a company they trust. It's good for the company, that the embedding company, because it's increased the revenue and it's also increased the stickiness of the customers. It's obviously it's good for us because it's a good acquisition channel that is fairly very profitable.
Rick.
Yeah, look, I completely agree with Guy. I think long gone are the days where companies can tell customers how they should engage with us. I think that's something we can learn from Amazon. Amazon didn't immediately try to figure out how are they going to monetize the scenario. What they said is, what do customers want? How do we engage? And to go one step further than what Guy said, we recently announced in our investor day that 50% of Hippo's new policies come from some form of an embedded insurance product through partnerships, whether it's a home builder, a loan originator, a loan servicer, title, realtor, all of those aspects. It's important to meet the customers where the customers want to be met. And that's where partnership, I think, is super important. Even if you're an agent distribution play, figure out a way that agents can get access to your products really, really quickly. There's a really cool company called Agent Sync that does sort of that automated agent onboarding process for product providers. So how do we simplify a way for our products to get to the customers the way that they want to be reached? And I think it's the future, frankly, of insurance, where you're buying a home and they say, do you need insurance? It's a requirement. The quote's already there. You don't have to answer a single question. The quote's already there and you say yes and you're done. That's the future of insurance, in my opinion.
Yeah, thank you very much. I'd like to add that in my perspective, also in Asia and other places, embedded insurance has a big role in getting insurance for the first time for people that was never insured, and also for underinsured and underserved populations, and this is also part of this. Since we only have 3 minutes, I think I'll skip the ecosystem question, and we will go directly to this question: public versus privately held. So I think, Rick, you went public a year ago with high expectations during a period of turmoil in the capital markets. Guy, it appears you have decided not to do an IPO during these turbulent times. So would you both be able to provide us with your perspective on the outcome of your decisions, either public or not public?
I'll go ahead and start. I think, like most things in life, timing is incredibly important. And I think that really trumps a lot of thoughts in this area. So let's take Hippo as an example. We went public we sort of priced the public round right before the downturn. We were able to raise close to $1 billion at a $5 billion valuation. I think it was a brilliant move because now we have plenty of cash to get us to EBITDA profitability, where we don't have to focus on going out and raising funds and trying to make some of the decisions in a downturn that you have to make that really aren't good for the long-term aspects of your business. So in our perspective, I'm lucky as hell we raised $1 billion. I think if you're trying to make that decision now, which is probably what Guy decided, maybe not a great decision because of what's going on in the public market. So I do think timing really, really matters.
We decided not to go public several years ago, although we got a lot of pressure to go there and many people contact us and all our peers went public. We didn't think we are ready. We think in order to be ready for public company, you need to, one, have a significant scale. We didn't have the scale back then. We need to be predictable on our future and be able to predict a few quarters forward and not miss any quarter when we go public. And we need to be closer to profitability, or at least have a path to profitability. We didn't feel any of this. We were not ready with this and decided not to go public. The second thing, we felt we can raise money in the private market at that point. Yeah. And we just went to the private market to raise money. It's much easier to be a private company and execute as a private company. And I also feel lucky we didn't go public. I think it's helping us right now.
Great. So thank you very much. I really enjoyed this discussion. Thank you, Madhu, Guy, Rob, Rick. And I hope you enjoyed this discussion and have a great day.
Thank you, Gil.